Reverse mortgages, financial risks and consequences. A reverse mortgage allows homeowners to tap into their equity without monthly payments, but the primary financial risk is the rapid accumulation of compound interest. Unlike a traditional mortgage where the balance decreases over time, a reverse mortgage balance grows as interest is added to the principal each month. Over several years, this compounding effect can significantly erode the remaining equity in the home, potentially leaving very little for the heirs. Because the interest rates on these products are often higher than standard conventional loans, the debt can escalate much faster than the home's market value appreciates. Consequently, the homeowner may find themselves in a position where the loan balance consumes a vast majority of their primary asset. Another significant consequence is the potential impact on government benefit eligibility and future financial flexibility. While the loan proceeds themselves are typically not considered taxable income, they can affect needs-based programs if the funds are kept in a personal account for too long. If a homeowner decides they want to move to a smaller residence or a long-term care facility later in life, they might discover that the diminished equity makes such a transition financially impossible. The cost of eventually buying out the mortgage or selling the home to move is often much higher than anticipated due to the accrued interest and initial closing fees. This lack of liquidity in later years can create a stressful, locked-in effect where the senior has limited options for changing their living situation. Homeowners also face the risk of technical default if they fail to meet strict residency and maintenance requirements. Even though there are no monthly mortgage payments, the borrower is still strictly responsible for paying property taxes, maintaining comprehensive insurance, and keeping the home in good repair. If a homeowner falls behind on these obligations, or if they are away from the home for an extended period, such as a hospital stay exceeding 12 months, the lender can declare the loan due and payable immediately. This can lead to a forced sale of the property during a time when the homeowner is already physically or financially vulnerable. Failing to adhere to these fine print conditions can transform a lifetime housing plan into an unexpected and urgent legal crisis. Finally, the long-term consequence of a reverse mortgage is the reduced legacy for beneficiaries and the burden of settling the estate. When the last surviving borrower passes away or moves out, the loan typically becomes due in full within a relatively short window of time, often 6 months to a year. Heirs are then forced to choose between paying off the massive balance with outside funds or selling the family home to satisfy the debt. In many cases, the high costs and interest rates mean there is very little cash left over after the sale to distribute among family members. This can lead to complicated estate planning issues and emotional stress for loved ones who may have hoped to keep the property in the family for future generations. Banks protect their financial interests in a reverse mortgage primarily through the integration of non-recourse clauses and conservative loan-to-value ratios that account for long-term market volatility. By limiting the initial loan amount to a fraction of the home's appraised value, often between 30% and 55%, lenders create a significant equity cushion that absorbs the compounding interest that accumulates over the life of the loan. They further safeguard their position by requiring the borrower to maintain the property in good repair, pay all property taxes, and keep comprehensive homeowners insurance active at all times. Failure to adhere to these technical default allows the bank to declare a technical default, providing a legal mechanism to call the loan due before the debt exceeds the property value. Additionally, banks utilize independent legal advice requirements, ensuring that the borrower has consulted with a third-party lawyer to acknowledge the terms and risks associated with the eroding equity. This strategic use of protective measures makes challenging a bank's position exceptionally difficult because it creates a robust, documented trail of informed consent and contractual compliance. Since the borrower must typically sign an acknowledgement of independent legal advice, confirmed by a lawyer's certificate of independent legal advice, it becomes nearly impossible for heirs or the borrower to later claim they did not understand how the rising debt would consume the estate's value. The specific language in the mortgage contract often grants the lender broad discretion to determine what constitutes adequate maintenance, making it difficult for a borrower to legally contest a default triggered by property neglect.
Furthermore, because the interest rates and compounding schedules are clearly disclosed and agreed upon at the outset, courts generally view the resulting high debt levels as a predictable contractual outcome rather than an unconscionable practice. This combination of documented legal counseling, strict maintenance covenants, and clear disclosure of the no equity left risk effectively insulates the lender from most common litigation strategies regarding predatory lending or lack of transparency. To learn more about our law firm's financing legal practice, including the provision of independent legal advice in relation to reverse mortgages in Alberta, visit our website and contact our law firm to schedule an initial consultation. Thank you.